Happy Wednesday, everybody. Welcome to another episode of Market Update, where we discuss leading economic and financial analysis in Europe, Asia, and North America. My name is Tony. Today's episode is being filmed in a hotel room. Please forgive the informality of this environment. Now, we have a lot to cover. Let's jump in. And first up, let's begin in North America. Underlying US inflation accelerated in July, driven largely by rising service costs, even as tariff-exposed goods prices increased less than feared. The data has raised expectations that the Federal Reserve may lower interest rates when it meets in September. The Core Consumer Price Index, CPI, which excludes the often volatile food and energy components, rose 0.3% from June, its fastest pace since January, according to the Bureau of Labor Statistics figures released on yesterday. Year-on-year core CPI rose to 3.1%, exceeding expectations and marking its highest level since February. Acceleration was fueled by a sharp pickup in services prices, excluding energy, which climbed at their fastest rate this year. Airfares surged 4%, the largest jump in more than 3 years, while medical care and recreation costs also rose. Dental services posted their biggest increase on record. Housing costs, the largest component of services, rose 0.2% for a second month. US President Donald Trump, who has been repeatedly urging the Fed to cut rates, renewed his calls after the report. Analysts noted that the impact of tariffs so far has been muted, with many companies and exporters absorbing costs rather than passing them on to consumers. However, economists caution that shifting tariff rates could still affect prices in the coming months. Markets reacted positively. The S&P 500 and the Nasdaq 100 hit all-time highs, and the benchmarks in Tokyo, Hong Kong, and Sydney, so we're looking here at the Asian markets, all opened higher today, Wednesday. Money markets have also priced in an about 90% chance of a Fed reduction next month. One closely watched Fed inflation gauge, all services prices excluding housing and energy, rose 0.5%, one of the strongest gains since early 2024. Headline inflation held steady at 2.7% year-on-year, restrained by a 0.1% drop in grocery prices and a 1.1% decline in energy costs, including a 2.2% fall in gasoline. Real average hourly earnings rose 1.2% from a year earlier, offering some relief to consumers facing higher service costs. The US president hailed the BLS's inflation numbers as evidence that his tariff regime was working, expressing on social media, quote, "Trillions of dollars are being taken in on tariffs, which has been incredible for our country. Tariffs have not caused inflation or any other problems for country." End quote. He also criticized Goldman Sachs and the bank's chief executive, David Solomon, for refusing, quote, "to give credit where credit is due," end quote, arguing that they had, quote, "made a bad prediction a long time ago on both the market repercussion and the tariffs themselves, and they were wrong," end quote. He said Solomon should recruit a new economist or, quote, "just focus on being a DJ." End quote. While July's figures align with forecasts, pickup in underlying inflation could complicate the central bank's decision-making ahead of its September meeting. Next up, we move to Asia, and we need to discuss China. Beijing has quietly instructed Chinese companies to avoid using Nvidia's H20 processors, particularly for government-related projects, dealing a potential blow to the chipmaker's efforts to regain ground in the world's second largest economy. The move follows Washington's reversal of a near ban on such sales, a decision secured under President Donald Trump on the condition that Nvidia and Advanced Micro Devices Inc., AMD, share 15% of related revenue with the US government. We discussed this in detail on my other channel, China Update. Over the past several weeks, Chinese regulators reportedly have sent advisory notices to state enterprises and private firms discouraging the use of Nvidia's less advanced H20 chips in sensitive applications. While not an outright ban, the guidance was strongest for government or national security work. Beijing's push also extends to AMD's MI308 processors, although specifics remain unclear. The policy coincided with a sharp rally in Chinese chip stocks as investors anticipated gains for domestic suppliers. The stance shows China's dual priorities, addressing national security concerns, including unverified claims that Nvidia chips could enable location tracking or remote shutdown, and accelerating the growth of its homegrown semiconductor industry. Despite these headwinds, analysts say Chinese firms are unlikely to abandon Nvidia entirely. entirely. Quote, chips from domestic manufacturers are improving dramatically, but they might not be as versatile for specific AI workloads, end quote, said Holm Lee of Lombardo-Deer, predicting continued demand for US chips in certain applications. Rosenblatt Securities' Kevin Cassidy agreed, arguing that Nvidia's processors still outperform local alternatives. The H20 was custom designed for China to comply with long-standing US export restrictions on high-end AI hardware. While less powerful than Nvidia's flagship GB200 or H100 accelerators, the H20 offers high memory bandwidth that is well suited to AI inference tasks, making it attractive to companies like Alibaba and Tencent. Domestic champion Huawei Technologies Co. has advanced chip designs of its own, but faces production bottlenecks that limit supply. Beijing's strategy mirrors earlier restrictions on foreign technology, such as Tesla vehicles and Apple iPhones in sensitive locations, and its ban on Micron technology chips in critical infrastructure. Officials are reportedly considering expanding the current guidance on Nvidia and AMD chips to a broader set of industries. Beijing appears to be racing to create its own domestic producers, but in the meantime must accept foreign supply to meet industry needs. As RAND researcher Leonard Heim puts it, quote, domestic alternatives remain inadequate even as China pressures foreign suppliers. End quote. If Chinese regulators extend their guidance more broadly, Nvidia's China sales could face greater strain, potentially undermining both Washington's revenue-sharing arrangement and its leverage in the global AI race. Now, we have one more development to cover, but just quickly, if you're getting some value from today's episode of Market Update, it's a huge help if you can just hit that like button, subscribe if you want to continue to be on top of the most up-to-date analysis on these kinds of developments. Sharing is a big help too. Thank you so much, everyone, for the ongoing support. Now, finally, we move to Europe. Europe's defense industry is undergoing its largest peacetime-to-wartime transformation in decades, expanding weapons production at triple the normal rate and adding over 7 million square meters of new industrial space. This rapid growth, tracked through radar satellite data and an accompanying report, an excellent report by UK-based The Financial Times, which we'll draw heavily from here, marks a tangible shift from political pledges to physical infrastructure, driven by Russia's invasion of Ukraine in 2022 and sustained by significant public subsidies. Analysis of more than 1,000 radar satellite passes over 150 defense facilities in 37 companies revealed that around a third of sites linked to ammunition and missile production have expanded since the war began. These sectors are seen as critical bottlenecks in the West's military support for Kiev. The construction boom represents a move away from just-in-time peacetime manufacturing toward a sustained war-footing industrial base. William Albuquerque, former NATO Arms Control Director, described the change as, quote, deep and structural, end quote, noting that mass production of shells lowers costs and accelerates missile output. Between 2020, 2021 and 2024, 2025, areas showing development jumped from 790,000 to 2.8 million square meters, with work ranging from large-scale new builds to fresh road networks and site excavations. One of the most notable projects is in Hungary, where Rheinmetall and state-owned N7 Holdings have opened a vast ammunition and explosives complex, initially producing 30mm rounds for infantry vehicles. The site will soon add production lines for 155mm artillery shells and tank ammunition, along with an explosives plant. The EU's €500 million Act in Support of Ammunition Production, ASAP program, has played a pivotal role, with 20 ASAP-backed sites showing major physical growth. Beneficiaries such as MBDA in Germany and Kongsberg in Norway have significantly increased missile production capacities, with the latter reporting an exponential output boost. The UK's BAE Systems, supported by both domestic funding and rising orders, is set to increase 155mm shell production 16-fold. The EU Defence Commissioner said European annual ammunition capacity has grown from 300,000 rounds pre-war to around 2 million expected by year-end, with Rheinmetall alone aiming to produce 1.1 million 155mm shells annually by 2027. Yet actual output may still fall short of capacity, and industry experts warn of ongoing bottlenecks in areas like miniature jet engines for long-range missiles and explosive fillers. The EU is now negotiating a €1.5 billion program to replicate ASAP's funding model and expand its priority areas such as air defense, drones, and artillery. Manufacturers like Nammo, which used €55 million from ASAP to expand shell and propellant production, are urging similar initiatives to address broader defense needs. As Europe's factories roar back to life, the continent is building the industrial backbone for sustained deterrence, a generational shift in security policy with implications for NATO's strategy and the balance of power in Europe. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Wednesday, and I will see you for another episode on Friday.